Hello and welcome back to part 2 of this FAPS mock walkthrough. I hope you found part 1 useful. Within this part 2 I'll be covering tasks 4 through to 6. Let's now swap over to the mock and make a start. So then, task 4 is worth 24 marks and this task is about producing financial statements for sole traders and partnerships. This task contains parts A and B. Part A, 1. Identify whether each of the following transactions would result in an increase in the capital of a business for 4 marks. So the first one, drawings of £40 were taken from the business by the owner. So that certainly would not increase the capital. If anything, that would reduce the capital. So it would be, as that's not an option, no increase in capital. The next one, the business had made a loss during the period. Again, if there were an option to decrease capital, I would be selecting that one. But as there isn't, it certainly isn't an increase to capital, quite the opposite. So it would be no increase in capital. There was an injection of capital by the owner. Well, certainly that would increase capital. So the double entry for that would be to credit the capital account, increasing the balance, and debit the bank. So that would therefore increase capital. And then the owner transferred their personal laptop into the business. So although this is not a cash injection, it would still be an increase to capital. So the way that would work is we would debit our IT equipment because that would have increased in value if they are transferring the ownership from personal into business. So it would increase our IT equipment and we would therefore have to credit our capital because the value of that laptop is then owed back to the owner. So it would be an increase in capital. So an increase in capital does not only relate to an injection of capital by the owner in terms of money, it would also include any assets that were transferred from the owner to the business. The only other one that would also increase the capital would be if the business had made a profit, because that would increase the amount owed back to the owner. Okay, moving now to part 2 then. Identify whether the following statements are true or false, so 1 mark for each. The first statement, a credit balance on a partner's current account, means that the partner has drawn out more than their share of the profits. This would be absolutely false. So a credit balance on a partner's current account means that the business owes the partner money. So quite the opposite from drawing more out than their share of profits. It would mean that they still have money to draw out of the business. And then the second statement, the finance by section of a partnership statement of financial position includes the balances of the partner's capital accounts and current accounts. That would be absolutely true. So not a lot I can sort of add to that because it just is true. So the finance by section within the statement of financial position shows both current accounts and capital account balances. And then any increase in capital or drawings or salaries owed from the partnership to the partner would be included within those capital and current account balances. Okay, so scrolling down. Imran and Nancy run in hotels as a partnership. Their trial balance as at the 31st of March 20x8 is shown below. And we see that we've got trial balance here on screen. So let's scroll down. Part B then, complete the statement of profit or loss for the year ended the 31st of March 20x8. All numbers should be shown to the nearest whole pound. Any profit figures should be shown as a positive and any losses as a negative using a minus sign. All other figures should be shown as positive. And this is worth 12 marks, this one, so this is worth a lot. Okay, so our sales revenue has already been filled out for us. So the next part is to complete our cost of sales. Now our cost of sales is made up of opening inventory plus purchases less closing inventory. However, we do have 4 boxes here. So therefore I am expecting to see another account that can go in there The typical two here being purchase returns maybe, or carriage inwards. So let's have a look at what we've got. So we do have a figure for carriage inwards, so that will be our fourth box, so that's good to know. Now, it doesn't matter which order you put these in specifically, but there is a certain order I would probably recommend. So we've also got closing inventory here as well, which is good. We've got opening inventory and we've got our purchases figure. So I would always start out with opening inventory. So if we scroll down, let's try that again. So opening inventory, where right there you are. And let's have a look what the figure was for opening inventory. It was 9,290. So let's enter those in. These are 2 whole pounds, so no need for 0.00s here. I would then add in your purchases figure. So again, try that again. So purchases, where are you? There you are. So purchases, and we've got a figure of £213,050. So 213050. Now you've got two options here. You can either put your carriage inwards next and then your closing inventory, or your closing inventory and then carriage inwards. For the purposes of this, I will put closing inventory first, but it doesn't actually matter which way round you put these. So select closing inventory. And remember, this is going to be a minus because it's taken off your cost of sales, and that's 7,710. So 7710. Now, I would usually show this as a negative. However, it does state within the question, all other figures should be shown as positive. So other than the profit figure, if they made a loss, for example, which should then be shown as a negative, everything else should be positive. So I would usually put that as a negative, but because it asks for that specific format within the question, please don't make what could be a really easy mistake there and lose a mark just for not reading properly. So then the last one would be carriage inwards. And let's scroll up to get the figure. So that is 240. So carriage inwards is the amount on delivery that you have paid to buy your goods. Carriage outwards would be typically where you maybe offer free delivery for a customer, but obviously it isn't free to the business, you're just bearing the cost of that delivery. So that would be an expense, the carriage outwards, but carriage inwards is on purchases. So that would be 240. We can now calculate our cost of sales, which would be the opening inventory plus the purchases, less the closing inventory plus the carriage inwards. So if we do that calculation, that would give us £214,870. From there, we can work out our gross profit, which would be the sales revenue minus our cost of sales. So £1,653,080 less £214,870. And that gives us a gross profit of £1,438,210. Now we have an add box, so let's have a look. So some typical examples here would be discounts received, the gain on the sale of a non-current asset, or where we've had a reduction in our allowance for doubtful receivables. All of those would go under this add box. So let's see what we've got here. So we do have a discounts received amount, so it will relate to this 570. Let's just check that we've not got anything else, which we do not. Okay, so it would relate to our discounts received of 570. So drop this down and we should have, we've done it again. So drop this down. It doesn't allow you to scroll on these boxes. You do have to use the scroll bar on the right, or maybe that's just a me thing. So discounts received, and that would be £570. Okay, we can now start taking off our expenses. So let's scroll up and have a look what we've got. So we've got depreciation charges here. We've got, as I said, carriage outwards that I mentioned earlier. We've got irrecoverable debts. We've got other expenses of 1,263,776, so they're large. Okay, let's start getting these in then. So what do we see? So we got, let's scroll down. So we've got carriage outwards. That was the first one. We've got depreciation charges. So let's get those in as well. We got irrecoverable debts. And then we got our other expenses figure. There we go. Excellent. Right, let's get these in though. So carriage outwards was 3821. We then had depreciation charges of 92,590. So 92,590. Irrecoverable debts of 1,390. And other expenses 1,263,776. Okay, 1,263,776. Okay, and it's automatically add those up to give us our total expense figure. So all we need to do now is calculate our profit or loss. So we can do that by taking our gross profit, adding on our discounts received figure, and taking off our total expenses. So if we do that now, that leaves us with a profit or loss figure of £77,203. Okay, moving down then. So in the year ended the 31st of March 20x9, the profit for the partnership is £79,030. And then we've got some additional information. Profit is shared between Imran and Nancy in the ratio of 60-40. Commission earned by Imran was £12,004 and by Nancy was £15,280. Interest was calculated as follows, and we can see we've got interest on capital and interest on drawings. Part 2, complete the following appropriation account for the year ended the 31st of March 20x9. All numbers should be shown to the nearest whole pound. All figures should be shown as a positive. If any figure is 0, enter 0. Okay, so our appropriation account basically takes our profit earned by the partnership and then we need to adjust it for interest on capital, interest on drawings, commission earned, and if there were any salaries, which in this case, there is not. So the only thing that we add within our appropriation account is interest on drawings, which increases the amount of profit available for distribution, but everything else is bad for the business, although good for the partners, and is taken off to get our final profit available for distribution. Okay, so in that case, let's add on our interest on drawings, which it gives us here as 141 and 41. So 141 and 41. And we can see that it's adding them up in the total column for us here. And then in terms of what we need to take off, that will be our commission and our interest on capital. So our commission, it states, was 12,004 for Imran. And for Nancy, 15,280. And then interest on capital was 10,525 for Imran. Oh, and 10,525 for Nancy. So the same figure for both. So with that in mind, we can now calculate our profit available for distribution by doing our profit for the year of 79,030 plus our interest on drawings and then taking off our total commission and total interest on capital. So if we do that now, that gives us a profit available for distribution of £30,878. And then the profit share for the business is 60-40. So 60% going to Imran and 40% going to Nancy. So we do 60% of our 30,878, and that would give us an amount to go to Imran of 18,527, and then we would do 40% of our 30,878, and that would go to Nancy. So that gives us an amount of 12,351. And we can see that the total profit distributed should be the exact same as the profit available for distribution. If it isn't, something's gone wrong. Okay, excellent. So that finishes off task 4. Let's now move on to task 5. So then, task 5 is worth 18 marks, and this task is about accounting principles, qualities of useful financial information, and interpreting financial statements using profitability ratios. This task contains parts A to E. Part A, identify the principle being described in each of the following scenarios for 4 marks, obviously 1 mark for each principle. The first scenario then, value of goods sold but not yet paid for at the year end is included in the sales for the year. Okay, so it's goods that have been sold but not yet paid for at year end, and we are then including that value within our sales figures. So that to me straight away looks like the accruals concept. So let's have a look what we've got on offer. So we've got accruals, excellent to see. Business entity, going concern, materiality, and money measurement. Yeah, so that would apply the accruals concept, which is making sure that transactions are recorded within the accounts when the goods or services took place rather than when they were paid for or the money was received, which would be cash accounting. The next one, Rena owns a greetings card business. When she takes a card for her own use, she records this as drawings. Okay, so the principle here then, let's have a look at our options. So that would relate to the business entity concept, which basically means that the business and the individual are 2 separate entities. So all business transactions should be kept separate from those of the individual. So the personal transactions should be kept separate from the business transactions. Okay, and then the next one. Stationary items such as staplers are treated as expenses rather than non-current assets. So that would be, from these options, the materiality concept. So obviously a stationary item such as a stapler is low value. So although in theory the business does own it, it's not going to generate them any money. And what are you going to do as a business? It's pretty hard to depreciate a stapler over its useful life. You'd be depreciating it at about 10 pence per year. It's just ridiculous. You would never do that. So it would go as an expense in the business's accounts. So that would be materiality. And then the last one, employee morale is not recorded in the financial statements. So this would then relate to the money measurement concept or principle, which basically means that the transactions that go within the financial accounts need to have some sort of monetary value. And obviously employee morale, although great for the business, you can't put a value or a financial value on that. So that would be the money measurement principle. Okay, scrolling down to part B then. Identify the enhancing qualitative characteristics being described in the table below. So the first one, knowledgeable and independent observers can reach a consensus that the information is faithfully represented. So we need to select which enhancing qualitative characteristic that relates to. So we've got 6 on there, albeit there are only 4 enhancing qualitative characteristics. So straight away I can get rid of faithful representation and relevance, because the only enhancing qualitative characteristics we have are comparability, timeliness, understandability, and verifiability. So out of those options, I would say that the most appropriate would be verifiability. So this describes really users of accounts who have adequate knowledge to be able to read them properly, be able to evaluate those figures, and if needed, you should be able to provide backup for those figures to show how the business has come up with them. And then the second one, information is clearly and concisely classified, characterized and presented. So I think this one's probably a little bit more obvious. So this one would relate to understandability. So this is making sure that everything within our accounts is made as clear as possible. So we're not purposely trying to hide anything or make anything overcomplicated. Okay, moving now to part C then. Identify whether the following statements are true or false for 4 marks. The interpretation of a business's financial statements using ratios is only useful for potential investors. That's definitely false. So you think there's plenty of people who would use the financial statements. You've got customers, suppliers, it may be directors of the business. They're not only useful for potential investors, anyone who is looking at the performance of the business for whatever perspective they're looking at. For example, suppliers maybe making sure that the business has good liquidity to make sure that they're likely to pay. Customers may want to make sure that the business is financially stable so that you can continue to supply them, etc. So that'd be absolutely false. It is not just for potential investors. The next one, the usefulness of ratios is enhanced when they are compared to different businesses, different time periods, or industry standards. That would be absolutely true. So the ratios are useful. However, they are much more useful if we compare them to either previous years or different businesses, but within the same industry. Obviously, it's no good comparing necessarily between industries because they're going to be different for different industries. So for example, if you worked in manufacturing, that might be different to being a retailer, maybe different to being, say, a service sector business. They're all going to be quite different, but comparing to the same industries is definitely useful. So that one will be true. The next one, a disadvantage of ratios, is that they are based on past performance, which may not be valid for making predictions about the future. So that is true. I think people are aware that obviously it is based upon past performance. That is a limitation because things could change, obviously, in the future. However, it's all generally we have to go off. So they are the best option available, but obviously it doesn't mean that it's not a disadvantage, because it is. We know that things can change in the future. New technologies, fashion, etc., things change. And then the last one, all other things being equal, if gross profit percentage increases, then net profit percentage will decrease. Okay, that's definitely false. It's definitely not the case. I don't know why. If gross profit increases, that would mean that net profit would decrease. Usually be the opposite. Not always, but would usually be the opposite. Okay, so scrolling down. You have been provided with the extracts from the accounts of a client for the year end of the 31st of March 20x3. So we can see that we've got an extract from the statement of profit or loss, and we've got an extract from the statement of financial position. Part D then, calculate the return on capital employed. Enter your answers to 2 decimal places. Okay, so return on capital employed is calculated as net profit, which we're given as profit or loss in this example, over capital employed. Now, capital employed can be calculated in 2 different ways. We can either do the non-current liabilities plus the capital figure, or we can do non-current assets plus current assets less current liabilities. They will give us the same answer. So just to recap that very quickly, your capital employed figure can either be calculated as non-current liabilities plus capital, or total assets, which is your non-current assets plus current assets, less current liabilities. They will give you the same figure. So to calculate our return on capital employed, all I would do is take our profit or loss of 59,160 and divide that by our capital employed. Now for this example, I'm going to use the non-current liabilities and capital. So add the 2 together, which gives you a figure of 233,900. So I would do the profit of 59,160 over the capital employed of £233,900 times 100 because it's a percentage, and that would give you a return on capital employed of 25.29 to 2 decimal places. And then part 2, calculate the net profit margin, again entering your answers to 2 decimal places. So the net profit margin, nice and straightforward, would be your profit figure over the sales revenue figure. So profit divided by sales revenue times by 100. So it would be 59,160 divided by 423,700 times by 100. And that would give you a net profit margin percentage of 13.96%. So let's enter that in, 13.96. Okay, so then moving now to part 3. Shop wages as a percentage of revenue has risen this year. Part 3, identify whether the following scenarios could have caused this change. So 1 mark for each scenario. Scenario 1, employees were awarded a pay rise during the year without any corresponding increase in revenue. Well, that could have absolutely caused the change. If the revenue has not gone up, but the wages have increased due to a pay rise, that could have obviously caused the wages to be a higher percentage of revenue figure. So that would be absolutely yes. And then the next one, revenue has risen during the year due to increased advertising. No extra staff were employed in the shop. Well, that definitely wouldn't have caused the change. So if your revenue has gone up, but your staff costs have just stayed exactly the same, that would have obviously meant that the wages as a percentage of revenue would have gone down because the wages would have stayed the same. Okay, part E then. Identify whether the following statements are true or false for 2 marks. The first one then, if a business has a markup of 25%, the profit for the year will always be positive. Well, that would definitely be false. So the gross profit for the year you would expect to be positive, but the profit for the year not necessarily, because obviously we have expenses within the business and they're deducted from that gross profit before you get to your profit for the year. So the business could have had high expenses within the year, causing them to have a loss. So that one would be false. And then the last one, the statement of financial position is completely independent of the statement of profit or loss. Again, absolutely false. They are connected in 2 different ways. Firstly, your closing inventory, which is recorded in both the statement of profit or loss and the statement of financial position. And they are also connected by the profit or loss figures, which again are recorded in both the P&L, so your statement of profit or loss, and within the statement of financial position. Having made a profit, that would increase the amount of capital. If they had made a loss, that would decrease the amount of capital owed back to the owner of the business. So connected in 2 places and definitely not independent. Okay, so that finishes off task 5. Let's now move on to task 6, which is our final task. So then, task 6 is worth 12 marks, and this task is about preparing accounting records for incomplete information. This task contains parts A and B. A business operates in an industry where standard credit terms on both sales and purchases are 30 days. Actual credit purchases for the year were £102,320. VAT can be ignored for this question. Identify which one of the following is most likely to be the closing balance on the trade payables account. Okay, so fairly straightforward this one. If you are operating on 30 days credit term and your credit purchases for the full year are 102,320, we could expect that roughly 1 month would still be owing at the year end. So all I would do is take 102,320, divide it by 12, to get a monthly amount of roughly 8,526. So we need to identify which one is the most likely. Well, given that 1 month of our credit purchases would be approximately 8,526, obviously they will differ a little bit between months, but the closest one there would be 8,726. So the most likely, based upon 30 days credit term, would be 8,726. Just be careful in these questions because this all relates to credit purchases, but sometimes they do it where they give you the total purchases and only part of them relate to credit purchases. The other part are cash purchases. You would need to remove the cash purchases first because obviously they don't have any credit terms. So it only should ever relate to credit purchases when doing this sort of task. Okay, scrolling down then. So the business had estimated that average trade receivables would be 16,800. However, you have exported a year-end trial balance from the accounting software, which totals 25,750, so quite a bit higher than what they were expecting. Identify which one of the following actions should be taken next. So we've got three options. Check the accounting software for errors and investigate whether there has been any reason for an unusual balance. Well, that sounds a relatively reasonable option. Let's have a look at the other two. Report the figure that is produced by the accounting software. So I'd probably hold off from doing that until you've investigated why it's higher, because it is significantly higher. As a percentage, if we think about this, if we thought 16,800 and it's come out at 25,750, that's, as a percentage, that's quite an increase. That's roughly around a 50% increase, isn't it, on what you expected? So I wouldn't just report the figure because it is quite a bit higher. And then the last one, report the figure that you have calculated as it looks more reasonable. Okay, we definitely wouldn't want to do that because obviously the system says something else. So we'd want to check the accounting software for errors and investigate whether there has been a reason for the balance. Okay, moving down then. AJ runs a business as a sole trader. You have received the following information relating to the financial year ended the 30th of June 20x9. All sales and purchases are subject to VAT at 20%. So we can see that we've got the day books here, we've got sales and purchases, we've got the balances at the start and end of the year on the trade receivables and payables, we've got the bank summary which shows receipts and payments from the bank. So all we need to do then for part B is prepare the payables ledger control account for the year ended the 30th of June 20x9, showing purchase returns as our balancing figure. Okay, no problem at all. So we've been given our start and end balance. So our balance brought down at the beginning of the year, our starting balance was 10,281. Okay, so let's enter that in as our starting point then. So bearing in mind that our payables ledger control account is a liability account. It is the amounts owed to suppliers. So it will always have a credit balance on this because it's a liability. So the balance brought down at the start of the year was 10,281. So let's enter that in to start off with. Purchases made throughout the year would increase the amount owed to suppliers. So let's have a look. So we made purchases, and bear in mind we need to take the gross value or total value here because that's how much is actually owed to those suppliers. We don't pay them net, do we? So it would be 194,160. So let's get that figure in. So purchases, I've already forgot it, that's poor. 194,160, so 194,160. So now that we've filled out our purchases, let's see what else we've got on there. So we've got the amounts that were paid to our suppliers. So obviously once we've paid those, we no longer owe that money. So it is a reduction to our liability within our payables ledger control. So therefore we'd select bank because we pay them from the bank, and it'd be 187,129. Now we've also been given our end balance for our trade payables with our balancing figure relating to the purchase returns. So your balance carried down on the payables ledger control will always go on the debit side because this will always be the lower side. You cannot have a negative payables ledger control account. You either owe your suppliers or you don't. So therefore our balance carried down would always go on the debit side of the account because it will always be lower. And we've been given this figure, it's 15,482. So let's enter that in. Okay, and then our final figure, our balancing figure, will relate to our purchase returns, which again will always be on the debit side of the payables ledger control account because it reduces the amount owed to suppliers. Obviously, if the business has returned something, they no longer owe them for those goods or services. And this would be your balancing figure. So all we would do here is we would check to see what the difference is between the debits and credits, as we would do if we were entering in the balance carried down. But obviously, we've already been given that figure. So the purchase returns would be the difference, i.e. the balancing amount between the two sides. So all we would do is the difference between 202,611 and 204,441, which are the two balances. And that gives us a balancing figure relating to purchase returns of 1,830. And we can now see that our debit and credit columns match up. Okay, so that finishes off task 6 and indeed the last task on this exam. And that wraps up this mock walkthrough. I hope you found it useful. And remember, if you have, to hit that like button and subscribe to the channel for more AAT videos. Thanks again for watching. I'll catch you in the next one.